monetary policy matters because it determines the inflation rate. And the inflation rate, we've had pretty low inflation for the last few years, kind of have sort of become less concerned about it. But there's nothing that guarantees we'll continue to have low inflation, except if the Fed pursues the right policy. So high inflation is very damaging. There was an interview in the Wall Street Journal, was it today? Yesterday, with Paul Volcker, very brief excerpts from an interview. And the interviewer's first question is, do you think inflation's a problem if it's correctly anticipated? And Volcker said, where'd you get that question? Have your professors been teaching you that perfectly anticipated inflation is no problem at all because everything adjusts? That's crazy. Everything doesn't adjust, right? First, people don't correctly, well, I'm interpolating here. Everything isn't correctly anticipated, but secondly, unless your tax code is perfectly indexed, which ours is far from being, you're going to have significant real effects when inflation goes up. So that's an important thing about monetary policy. It determines the inflation rate. And second, we've talked about the idea of dampening business cycles. And I said in the first lecture that fiscal policy can't really do that, but monetary policy could if it's properly run. So let's look at the Fed's track record. And here's the Fed's policy mandate in the Humphrey-Hawkins Act: maintain long-run growth of the monetary and credit aggregates, right, so that's what they control, so as, here's the goal, promote effectively the goals of maximum employment, whatever that means. I mean, if you took it literally, it meant that everybody should be working, even 5-year-olds. Stable prices, that the Fed can control, meaning the price level, and moderate long-term interest rates, and that they can do by keeping inflation moderate. But the first one is troubling. So how well have they done? In order to dampen business cycles, here's the potential for monetary policy to do something constructive. If people decide to hoard money, for example, in 2008, the rate of spending out of existing money balances fell dramatically. People became concerned about the future. They don't spend so readily. You can call that hoarding, or if you, the term monetary economists use to denote how rapidly each dollar turns over on average, how many times a year it's spent, they call it velocity. So velocity fell. People are holding on to their money longer. In terms of the aggregate supply and demand diagram, which we saw in my first lecture, that's a shrinkage in aggregate demand. The aggregate demand curve comes in toward the origin. So there's less demand for goods and services at any given price level because people are hanging on to their money and not spending it. There's less spending. So the short-run equilibrium will be lower prices and real output shrinks. You have a recession, a deflationary recession, or a disinflationary recession. So what could monetary policy do? It could boost the aggregate demand curve back up. So instead of going to the lower aggregate demand curve, if the Fed saw the drop in velocity coming and was there right in time to boost the amount of money in the economy, that would offset the reduced willingness to spend out of existing money. Well, give people enough money and they'll be satisfied now with the amount they're holding, and they'll go back to their normal rate of spending. That's the idea. So if you don't treat that drop in velocity, you have a recession. If you treat it properly, you stabilize aggregate demand. But notice what's necessary. You got to do it at the right time, and you got to do it exactly in the right amount. Because if you do it too late and too much, you end up swinging the economy in the opposite direction beyond full employment. And in practice, that's what the Fed's done. So if you think of the economy having swings in it, even if monetary policy is steady, because demand for money is subject to changes, if monetary policy is poorly timed and of the wrong magnitude, you can actually exaggerate the swings. This kind of trying to fuel the economy and then trying to slow down the economy sometimes is analogized to driving a car. The Fed steps on the gas, the Fed steps on the brakes. It's a stop-go policy. Well, if you get the timing wrong, the Fed's stepping on the gas even as the economy's recovering, then the economy overshoots. The upside is actually exaggerated. And then the Fed said, oh my gosh, inflation, they step on the brakes, the economy overshoots in the other direction. So you get bigger swings in the economy. And that's a possibility, and that's what it looks like the Fed has actually done. That was Friedman and Schwartz's conclusion after looking at the history of the Fed's actions. And it's hard. I mean, it's not that the people at the Fed aren't as competent as anybody. It's that nobody has the competence to do this because it takes too much knowledge. Right? The timing, the forecasting is not all that great. And you need to forecast because increasing the money supply doesn't immediately get people to spend more. When people get more money, they sort of think about it before they decide what to spend it on. There's a long and variable lag, is the famous phrase, between changes in the money supply and changes in aggregate demand by the public. So that makes it a hard problem, and the Fed has not been miracle workers in this. So let's sort of step back and look at the Fed's history over the long period, over the last century, and compare it to, it's the only sort of standard comparison, well, it's not the only one I can think of, but it's the one that I can do. I mean, another standard of comparison could be compare the Fed to the Swiss National Bank and see how they've done compared to them. But let's compare the Fed to the previous U.S. system before the Federal Reserve Act. That was a gold standard system, the classical gold standard it's sometimes called. 1879 is the starting point because that's when the U.S. rejoined the gold standard after the Civil War. So here's the price level. And I put it on a log scale so that the slope shows you the percentage rate of increase. So otherwise you get an exaggerated picture of inflation. So this is designed to not overstate our current inflation or our post-war inflation. If you look at the shaded yellow period is under the gold standard, the price level declines slowly for the first half and then rises slowly for the second half. That basically corresponds to the economy growing rapidly and then the high purchasing power of gold stimulating prospectors to go out to the Yukon and dig up more gold and develop this cyanide process. Those things bring the price level back up, but it ends basically where it began. A bundle of goods that cost $100 to buy in 1879 cost $99.95 in 1914. That's about as close as you can get to price stability. Okay, prices fell by 0.05%. From 1971, just look at 71 is the end of the last vestiges of the gold standard. Right? Under Bretton Woods, the dollar was redeemable at $35 an ounce, not for the U.S. public, but for foreign central banks. That ends in 71. Since 71, the inflation, up to 2010, the inflation rate's been close to 4%, 3.8%. So much higher inflation rate. It's better now than it was in the 70s and late 60s and 70s. I'll grant that. But on average, it's been higher. A second thing that's a little less obvious, I mean, everybody knows that, right, a dollar today only buys what 4 cents bought in 1914. Something that's less obvious is that the ability to predict the future purchasing power of the dollar has gone down. And why is that important? Because if you want to make a long-term investment, then you want to borrow money long-term, because if you had to refinance it several times during the length of the investment, that would be risky. You don't know what interest rate you're going to pay. So you'd like, for a 20-year payback investment, you'd like to borrow money at 20 years, or 30 years for a 30-year investment, 50 years to build a railroad. Railroads used to issue 50-year bonds. Under the gold standard, people would buy 50-year bonds denominated in dollars because they knew what a dollar would be worth in 50 years. Right? It stayed pretty close to the historical purchasing power of the dollar. Nowadays, nobody issues 50-year bonds because price level uncertainty is so much greater. And these charts show measures of that. And over the entire post-1971 period, you can see the average is higher than it was in the pre-Fed period. And it swings around more. Another way to measure that is how far off would you be if you forecasted the future price level just by extrapolation? And that's what you see in the bottom two graphs. You'd be very close in the pre-Fed period, but in the post-World War II period, you'd have made some big mistakes. If you look at the entire Fed period, 1915 to 2009, you see the output volatility is much higher than in the pre-Fed period. Again, if you take out the interwar period, if you take out 15 to 46 to give the Fed the most favorable, because they have learned a little bit, most favorable comparison, and just look at post-World War II period up to 2009, the number is, okay, it's 2.55 versus 2.66. Statistically, that's not a significant difference. And if you include it up to the present, the later figure would go up because we're still, below trend. So output volatility hasn't gone down, despite the economy being better diversified. And econometricians have tried to distinguish what's making the economy vary. Is it demand shocks, which the Fed could in principle fix, or is it supply shocks, harvest failures and so on? During the gold standard, it was more harvest failures and fewer demand shocks. Today, it's more demand shocks. So the Fed has an easier job. That's what the Fed can fight, but they haven't done it. They haven't even reduced the resource costs from producing gold, which is a traditional argument for going off the gold standard. Real price of gold today is higher than it was under the classical gold standard. Why? Because people are hoarding gold as an inflation hedge, but that means there's more gold mining to satisfy that demand, so we haven't saved the resources. If you look at the unemployment rate, the Fed hasn't reduced unemployment. Now, I said before, you shouldn't expect them to, so this isn't really condemning the Fed, but it's saying if you expect it to reduce unemployment, then you're barking up the wrong tree. So, how do we get better results? Well, if you could make what the Fed does more predictable, that would be a service. So the Taylor rule is an attempt to do that, to create a formula for Fed policy that people in the market can see the inputs, they can observe the inflation rate, they can observe the measurement of output versus potential output, they can predict what the Fed's policy is going to be. And it worked pretty well when it was tried, or when it seemed to be tried under Greenspan. That was the great moderation when the Fed was following the Taylor rule. Instead of having a dual mandate where the Fed responds to deviations of output, give the Fed a single mandate. So there are proposals in front of Congress now to do that. Either target the price level or, what I would prefer, target the path of GDP. Right? That means stabilizing the aggregate demand curve in terms of aggregate demand and supply. Bennett-McCallum has a formula for doing that called the McCallum rule. Scott Sumner has proposed improving on that by using market forecasts. McCallum's rule is backward-looking. If you could automate the process of using market signals to try to forecast nominal GDP, that would help. And lastly, I've been comparing the Fed to the gold standard. This is probably sort of beyond the political pale, but returning to a commodity standard would make it possible to return to the, if it were international, return to the stability of the classical gold standard, and then do what the Fed reformers didn't do in 1913, which is move toward a more decentralized, competitive system of banking and note issue. But as I said, I include that to make the earlier ones look more moderate. Right? But trying to fasten some kind of rule on the Fed seems to me would help.